Hello, everybody, and welcome to Market Psychology 101, where we look for value in the markets when there's fear and to be cautious when there's greed. If you are new to my channel, I am looking at growing a community for the casual investors, people with low to medium risk, long term investment mindsets, not for trading, but my goal is to simplify how to find greater value when you invest. A lot of investing looks very complicated when you first get into it. My goal is to try to simplify that as much as possible. I have a lot of years of experience educating people, experience in the field of psychology, which I am certified in, and I have used that knowledge and experience to do pretty well for myself in the markets. In today's video, we are going to be taking a look at the S&P 500. It's one of the best measurements of the US stock market overall. We're going to be taking a look at what happens when there are rate cuts and when inflation is high. We're going to try to be as unbiased as possible. Now, some of you may have heard about how there's bears and bulls in the market. And bulls are people that are very positive about the market moving forward. Bears are people who believe that the prices and the market is going to go down soon. I try not to get into that too much because when you make predictions with stocks, crypto, more often than not, you end up looking like an idiot. You're going to get things wrong. So when we look at stocks and crypto, you need to try to be as unbiased as possible. It's easy to want the price of something to go up when you hold into it and to feel bad or down when something you're holding is tanking in price. But we have to try to take a robotic look at it in market psychology, even a reverse psychology view at it, a contrarian view. Because when people are getting upset and sad that the price of their stocks are going down, that's when things are discounted and when we need to be opportunists, and when there is usually more fear in the market. Now, fear doesn't always coincide with market bottoms. That's okay. It can give us an indication of when things are better to buy. Anyways, let's get into this video. So I talked about how we're going to be taking a look at when rates cut and when inflation peaks. I have noted this with white lines and red lines. The red lines are that's when interest rates start to cut from their peak. The white lines are when inflation peaks. Now, some of you may have heard about the yield curve inversion, and I promise this has something to do with it. This is a very simplified, dumbed down version. It's more complex than this. So if some of you are very knowledgeable about the yield curve and the bond market, you can add more of your knowledge in the comments below. But it goes like this. When rates are low, the yield curve tends to be high. Again, there's more to it than this. When rates are raised and the price of bonds go up, the yield comes down. And we have, when we get under the zero line, this is the US 10-year minus 2-year, when we get down here, we have what's called an inverted yield curve. From the time of inversion, on average, over the last 70 years, from the time of inversion, typically a range of 6 to 12 months before a recession. Typically, the market's always changing, evolving. So I would say consider that number, but possibly also treat it with a grain of salt. So as you can see right here, this was the dot-com bubble. When the yield curve inverted in February of 2000, it uninverted in January of 01. What happened with stocks at that time? It inverted. You look at the bottom here for the date, January 2000, and it uninverted in 2001. And look what happened. Markets went down around 50%. Here's a ruler tool where you can measure how much things sink. If stocks go down over 20%, you need to strongly consider looking at the stocks you like and use that you can buy at discounted prices. Let's look again at the next case. This is the great financial crisis here. The yield curve inverted January of 06. It uninverted above the zero line real quick and then got inverted again. So let's just go with January of 2006. And it uninverted around the middle of 07. What did stocks do? Any of you remember the great financial crisis? You know what happened. So 06, and then it started to uninvert in 07. The time from inversion to recession for this great financial crisis recession was the longest amount of time from yield curve inversion to recession. When rates were cut both times, stocks tanked a little bit after. Here's when rates started to be cut, August of 07. Look how long till the bottom, March of 09. This was the longest amount of time in the great financial crisis that we had to wait until the bottom of the market and recession. Right now, markets are at an all-time high, the NASDAQ, the Dow, the S&P. We have an inverted yield curve. Like I said before, on average, it's about half a year to a year until the recession. This was July of 22. We are still inverted. This has been about 17, coming up to 18 months. So we have not gone this long since the great financial crisis. And I believe, should a recession play out, this will be either the longest or second longest amount of time from yield curve inversion to recession, should it happen. Again, let's look at the S&P. Some people make the argument that the recession was already priced in, or at least a lot of it, because from the peak here, and this was, by the way, when you see this on the stocks or crypto, this right here, this is the COVID crash, March of 2020. Y'all remember that, even though you don't want to, just for the sake of stocks. When this happened, Donald Trump was literally screaming at Fed Chairman Powell to lower rates. Rates got down to dang near zero. And we also stimulated the economy. You were all getting those stimulus checks. People had extra money in their pockets. The rates were dang near nothing. The housing market exploded. It exploded up. And everything ran. Look at this. From the bottom to the top, ran up 118%. After that happened, some people believe that part of the next recession, if there were to be one, is already priced in because stocks to late 22 sank 28%. It may be. You've heard people talking about a soft landing. And yes, stocks aren't just the economy. However, it is a reflection of it. And so just looking at this chart, I wondered, and I've wondered out loud, if maybe we're going to get a shape like this, like an M, something like that. My drawing skills suck. So let's journey with me to the past and see what has happened after rates have been cut before and when inflation has peaked. So most recently, when inflation was peaked in June of 22, the market was close to the bottom. We still had another bottom coming late 22 in October. This is when rates started to be cut before the COVID crash. Many people, economists, will tell you they knew a recession was coming back here, that they could have predicted it because rates were cutting. We had the inverted yield curve, even though it was a little one. Even though it was a little one, people were predicting it would happen. So let's go back. Let's find out when inflation was also peaked, and I'm going to say peaked within that decade or when it was very high before sharply going down. This is when inflation was peaked, and we can look at the percent later. When it was peaked in '08, maybe it was around 4 to 5%. And as you can see, the markets were already going down. This is when rates first started to be cut from their highs. So the Fed raised rates, and this is when they first started cutting. You can see from August of 07 to March of 09, almost 2 years until the market bottom. But within a year later, we knew we were going down. From the first rate cut, again, this is a great financial crisis, the greatest crash since the Great Depression. We went down 57%. I have an indicator that shows that this crash here was the only other one to have a pi cycle bottom like the Great Depression. I can show you that later. Here is when rates started to be cut. The market bottomed later, a little bit over a year. So when the Fed cuts rates, a lot of people think that is a bullish thing. And overall, it is later on. However, they usually cut rates because they see that there's too much damage. I'm simplifying now, that there's too much damage that's been done to the economy with high rates. Businesses are having a harder time surviving. People start to get laid off more. Unemployment's rising. And in recessions, unemployment tends to spike. Right now, unemployment is curling up. We had very low unemployment, COVID spike. People started getting jobs after we opened up again, and then it's slowly curling up. Should there be a recession, that's when we'll see it spike again. Where were we? So, rate cuts and then crash. The Fed isn't doing it to be nice. They're doing it because they have to. And they will raise rates. Again, this is dumbing it down. A big reason to do it is to squash inflation. So the white line, again, that's when inflation had a local high. And you can see the market was about bottom there. Here's when the Fed cut rates from the level that they raised it to. So they cut rates. That was May of '89. Year and a half later, we were at the bottom, inflation. The Fed cut rates here, nothing really happened. We had the '87 flash crash, and I highly encourage you guys to watch videos on the '87 crash. I believe there's some videos on YouTube. They're about an hour long. People did not see this one coming, and it wrecked a lot of people. They had to close the market down for a few days. It caught a lot of people by surprise. It's very interesting. Highly recommend researching this. 35% drop. Here is when rates were cut from their local high. We are already bottoming. Now, what's interesting about this time, this is when inflation had a triple peak. And we're going to look this up. Let's go back in time to the 70s. You've probably heard your father, grandfather, uncle talking about when inflation ran high in the 70s into the 80s, the Jimmy Carter days. And that's why Reagan came into power and Reaganomics changed everything. Here's when inflation had its triple peak. My parents got their house somewhere in '78, and I recently got a house a few years ago when rates were not what they are now. And I asked them, how high were rates when you got a house? Now, mind you, it was like $50,000 for a house back then. And my mom said it was something around 8%. 8% rates for a house. Could you imagine that right now? Hey, we're not far off. Rates got up to dang 15%, if not higher. Okay, this is inflation rate. House rates can even go higher. So Inflation peaked, and I've noted this on the S&P chart. This is what I'm talking about in the 70s. Let's go back to the S&P. That's this whole mess back here. So here's the 80s. Let's actually start from the beginning here. So that first peak of inflation is right here. As you can see, the market bottom wasn't too far off, about half a year from the inflation peak. They were raising rates, holding rates high. This is where they started to cut rates. Damage was being done, but look at this. Inflation was peaking. Again, that second peak of inflation that I just showed you. And the mistake the Fed made back here, that Jerome Powell, our Fed chairman right now, has said they do not want to make this mistake where they cut rates too early and then they get a greater spike of inflation. They are worried about that. Here, now these lines do overlap. I separated them just by a month, but it's close enough for you guys to get the point. Inflation peaked, and that's when they started rate cuts this time, from that 15% you just saw. So here is that local bottom, rate cuts. We went high and then had another sell-off. So let's measure those sell-offs from peak to low. I'm going from the top of the wick to the bottom. So the one on the left, 37%. I'm going from this peak, and I'm moving it over to the right so I can see the number, 49% for this one right here. Here, the peak didn't happen until a little bit later. This one, 28%. So is there anything from these conditions, which maybe are similar to today, that we can use to maybe judge what the market is going to do now? Well, as I've shown you, this is the longest it has been of a yield curve inverting without a recession since '08. So maybe the conditions of a recession since yield curve inversion are changing. They're getting longer. I've heard the expression of the Fed keeping a balloon underwater for longer, and when the balloon eventually shoots up, it does so violently, that's the markets coming down, that they're getting better at suppressing the problems as time goes on. Maybe. But can we take away anything so far? Here's when inflation was peaked, and like in the 70s when we had big inflation problems, like we did from all the extra money, all the low rates, everyone spending like crazy, of course it's going to drive inflation up. When you print around 6 trillion out of nowhere, when you increase the money supply. Let's show this money supply. The M2. You guys want to see how crazy this was? Look at this. This is COVID. They start printing money. Look at where this is. 15 trillion to 21, 22 trillion. So let's just say 6 trillion. They've been slowly weaning off of it. But as you can see, even though they say they're quantitative tightening, which means they're decreasing the money supply, they're keeping rates high, look at this. They still inject more. And I believe this may have coincided with the Silicon Valley Bank collapse. The Fed has a program that ends in March for the banks where they get to borrow money to help with their loans, because a lot of banks are in the negative right now because the drastic change in bond prices. Banks have held so much bonds, they're losing a lot of money on bonds because they used to be lower in price, all of a sudden rates are raised, the bonds are higher. A lot of banks are negative with their bond holdings. It's as best as I can simplify it. And so the Fed, the government, has a program right now where they're loaning money to banks. That expires in March. So watch what the markets do in March. Are we going to see a wave of bank collapses after? The government's trying to get ahead of the problem because in 2008, when Bear Stearns, Lehman Brothers, all those banks were collapsing, closing, shutting down. Let's go to '08. When we had the great financial crisis, all the banks closing. You remember those days, the government was doing bank bailouts. And a lot of people were pissed off because all these Wall Street brokers were getting bonus checks with that bailout money. And some have said that the conditions that led to this are mostly overall still around today. Now, are people able to get subprime loans, ninja loans as much, and have it as bad a mortgage? Are bad mortgages the problem again this time around? There's been a lot done in the mortgage business to not have that problem repeat. But you may have heard that in China, they basically had a pyramid scheme problem with their housing market. That's how people invest in China. 70% of investments, I've heard, go into real estate. And there's ghost cities and people who they're investing into housing that hasn't even been built yet, and there's no one to live in there. And you may have also heard about commercial real estate tanking because people are working from home, and maybe commercial real estate and the China real estate problem and the banks being negative will lead to this recession. You guys have seen that housing prices are high, et cetera, et cetera. Again, I got to check myself here because as I say these things out loud, it is easy for me to have a quote unquote bearish view. However, I am open-minded. Maybe things were priced in, and when the bank's loan ends March 11th, maybe we only see a 20% correction. Maybe we see a 50% correction. I'm open to anything, as I'm going to share with you on this channel. Create a plan of what to invest into. I say stocks you like, stocks you use, and when to invest, how to dollar cost average, taper in and out. Right now, the market's running up without a recession starting it off, without rate cuts starting it off. This is a bull market that's running up from good conditions. And so corrections are natural. They're going to happen. We're at 4,900. A lot of people are calling for 5,000. That'll be a psychological strong level for the market to truly show where it's heading. We'll see. I don't know. I'm not going to predict too much, or at least try not to. I just want to be ready for the conditions that meet my plan and to react to it and to jump into the markets when it does. So I've shared with you a lot of reasons on why you should be ready for a possible correction. Rates are going to be cut this year, most likely. Some people say that rate cuts might start in March. Some people say May. Some people say June. And what the Fed wants to do is keep rates higher for longer as much as they can to keep inflation down. They are targeting 2%. And as I've told you, Fed Chairman Jerome Powell is worried that if they cut too soon, they're going to get a greater spike in inflation. So let's take a look at where inflation is now. Inflation has curled up to 3.4%. 3.4. They want to get to 2%. 2% is a magical line that they are hoping for. Oops, sorry about that. Oop, here we go. Are you kidding me? I just want to get it close. I want to get it right on the line. I'm OCD like that. 2%. Oh, it's only going to give me 199. Don't you hate that when you're at the gas pump and can't quite get that extra 0.01? So that's the level that the Fed is aiming for. Inflation has recently curled up, and one of the things keeping inflation up is housing. Housing prices are still high. When housing inflation comes down, it tends to come down very dramatically. That has not happened yet. So take that for what it's worth. After seeing us go up in inflation, I don't foresee rate cuts happening in March. I could be wrong. I have no idea when the Fed's going to cut rates. I believe that should we start curling down and maybe get to the high to mid twos, that the Fed will cut rates. But what are they going to do if inflation stays strongly above 3 or even gets to 4 by the middle of the year? Are they going to cut rates? Because the economy is going to be suffering more and more the longer they keep rates up. Maybe they will try cutting and consider raising rates again. I don't know. I don't know what the Fed's going to do. I'm just here to share with you that their target is 2% inflation. And here they were probably feeling pretty optimistic. It went up, down, up. We'll see. So here's something else to note. On average, when the Fed first cuts rates, and this is on average, we have about 7 months until the local market bottom. So whenever the next rate cut happens, set your timers. We have about 7 months on average. A caveat to that is when rates were cut for the great financial crisis, when they were first cut, this was, I believe, one of, if not the longest amount of time until the market bottom. So look at this. August of 07, March of 09. We had a year and a half, roughly. So that's what? Over August, that's a year. September, October, November, December, January, February, March. So, yeah, 5, 6, 7. We had 19 months until the bottom here. It's early, forgive my slow brain. I did drink coffee. From the first rate cut to the bottom, we'll say the bottom's here. First rate cut, December of 2000, October of 02. That was a long time. So that one was 22 months. So maybe this one was the longest. Yeah, 22 months. Oh, and gosh, I forgot I could just measure on here. So the last 2 times we got these big recessions and big sell-offs. And again, guys, look at these sell-offs. 50%. This one was 58%. From the first rate cut, it took a while. So I don't know what's going to happen this time. We are already 17 months past the yield curve inversion, which has been a pretty solid indicator of future recession. 17 months. Like I said, with the great financial crisis, it was about 22 months from yield curve inversion to recession. So it does seem that as time's gone on, that from inversion to recession, it's about 2 years. So this is August 22. Will that mean that in August 24 or around this time that maybe we'll be inverted and a recession is going to happen over here? I don't know. It's possible it could happen middle of 25 if it is to happen. From the first rate cuts, again, about 7 months on average, but you guys saw that from the first rate cuts, it's about a year and a half. So this changes things. This changes things. A year and a half, 2 years. We haven't even had rate cuts yet. So even best case scenario, if rate cuts happen in March, a year and a half to 2 years, that puts us late 25, early 26. Is that when a recession is going to happen? So from the start of the yield curve, which I just showed you, when was that, by the way? From the start, July 22. From the start of the yield curve, July 22. Hey, look at that. It's right near this inflation peak. From the start of the yield curve, it's supposed to be about 6 to 12 months. We're way past that. We're at like 17, 18. Getting into great financial crisis territory or length of time. Is it going to happen earlier? Is it going to happen later? I don't know. No one knows. But here's where I'm going to come back to the importance of making a plan. I have another video on this. Please write out a plan. Of course, consult with a financial advisor, invest in the more solid things like money markets, Roth IRA, all that stuff. If you are doing investment on your own, whether it be with stocks, crypto, do your own research, invest in what you like, invest in what you use, and have a plan. We have some earnings coming up, and that's going to be my next video, where we're going to take a look at things like Apple, Microsoft. If there are stocks you like, stocks you use, have a plan on when to go in. Maybe when they drop 10, 20%. Look for that video, and I will show you some things to look for to maximize your value when investing in those stocks. So guys, I hope this video was helpful for you. Here are some things to consider, that if there's to be a recession, if something's priced in, if we're going to get, hey, if we get a great financial crisis, dot-com bubble, and we go down 50 to 60%, look where that puts us. Okay, right at the 2020 lows. If we had a great financial crisis, look at that. It takes us all the way back to 2015 level back here, which is interesting. This would be worst case scenario. This would also be obviously very bad for the markets, very good for you. Guys, if we get down 40, 50% plus, please invest into what you like and use. That'll be the opportunity of a lifetime. Even if it's 30%. I'm telling you guys, once we get 15%, I'm beginning to dollar cost average in. And I'm going to dynamically dollar cost average in a little bit more, like every 5%, a little bit more, a little bit more. I'm going to be aping in, YOLOing in, because, hey, if the economy tanks and ends and it's over, your money's worthless anyways. Might as well have it in something that increase in value over time, because if you invest, so we're going to take a quick look at Apple. If you would have invested into Apple during the peak of the 08 crash, okay, where is it? Down here. We had the great financial crisis, 09. Apple is around $3. It's 65 times higher now. That means every $1,000 you spent would be 65 times higher now. $10,000 would be $650,000 15 years later. That's why I'm telling you, if this is to happen, it'll be the opportunity of a lifetime. If we're getting even a mild recession, you don't want to wait with a bag of money and miss it. Let's say things were priced in a little bit and we only get back down to these levels. If we do, you don't want to miss it. I'm even going to get in front of it when it's 15, 20% down, when we'll get a correction. And guys, corrections like that are normal. 10% plus are normal. Those can create opportunities to go in. So I hope this video has been helpful to you, educational for you on how high inflation and rate cuts overall affect the market from a macro level, including with the yield curve. I'm not here to predict that a recession will happen. I think personally, there are a lot of strong indicators to say that a recession is coming. Again, I don't know. Now, a recession, of course, will come at some point in the future. Who knows when? The government, Wall Street, they're getting better and better at disguising it and dealing with it as time goes on. However, if they disguise it too much, that can tend to create bigger drop-offs. If they do too many things to suppress the balloon under the water, so to say. So, hope you guys enjoyed the video. Remember, none of this financial advice is just for educational, entertainment purposes only. Again, I'm using my knowledge, experience, certification in field of psychology, in teaching, consulting, educating, to help you and for you to make your own decisions. So, have a wonderful weekend. Stay safe. Consult a financial advisor, and make a plan, be ready should we get a big sell-off within the next year or two. Take care. Goodbye.